Hi everyone, today is 20th March of 2026. The Nifty 50 is down around 10 to 12% in the last 1 month, and many individual stocks are down 20% or more. And I have just one thing to say to anyone watching this video. If you're redeeming money right now from your mutual funds or liquidating your portfolio, then honestly, the stock market is not for you. Let me be blunt. I can almost predict the exact period when you entered the markets. It was between September and December of 2024, when everything was going up and investing felt easy. But this is what markets actually look like. You'll do yourself a favor by not coming back to the markets because I'm very sure you'll again enter a time when things are very euphoric. I understand there's a lot of fear around war currently unfolding in the Middle East. It's an unfortunate situation, and we all hope it does not escalate further or lead to more loss of life. However, I wanted to walk you through what the situation could mean from a financial market perspective. The reality is that markets have already been going through a very difficult phase. For almost 18 months now, returns have been flat to negative. While the headline indices are down around 10 to 15%, the broader markets have corrected nearly 30 to 35% in many individual stocks. The point I want to make today is simple. Sometimes markets feel the darkest just before the dawn. Recently, ICICI Securities published a very interesting chart analyzing major geopolitical escalations over the past 4 decades. Events such as the Gulf War in 1991, the Kargil War, and the World Trade Center attacks saw markets fall roughly around 12 to 13% on average. But it is important to understand the Indian markets were very different back then. Liquidity was limited, and domestic institutional participation was extremely low. If you look at the last 15 years, events such as the 26/11 attacks and the other geopolitical tensions have had much smaller impact on the markets. On average, markets have corrected only 7 to 8%, which is roughly where we are today. Even if the situation escalates further, another 3 to 5% correction is possible, but historically, these declines have been followed by very strong recoveries. Across such events, the next 12 to 18 months returns have averaged roughly around 20 to 25%, excluding extreme data points. The biggest mistake investors make during such times is reacting emotionally and following the herd. I also recently came across a very interesting observation shared by Radhika Gupta. She highlighted that Nifty has delivered almost 18 months of flat returns. Looking at the last few instances where this happened, starting from 2015, something interesting appears. After such consolidation periods, the next 12 months have delivered roughly around 20 to 25% returns on an average. Not just that, the following 2 to 3 years have also been positive. Another important change over the last 18 months is that valuations in India have cooled down significantly. Earlier, India was trading at a massive premium of nearly 160% compared to other emerging markets. Today, that premium has come down to around 60%, which is actually below its 10-year average. Other emerging markets have performed well recently, while India has relatively underperformed. But it is difficult to believe that the market with one of the strongest earnings growth profiles globally will continue to underperform. Today, India is available at a much reasonable valuations, both relatively and in absolute terms, close to long-term averages. Another key reason why India underperformed over the past couple of years was the global AI boom. India unfortunately does not have many large listed companies with strong AI exposure, unlike the United States. Because of this, global investors wanting AI exposure shifted large amounts of capital into the Nasdaq, which is dominated by technology companies. For example, in 2023, the Nasdaq was up about 54%, while the S&P 500 rose roughly 14%. But something interesting is happening this year. If you remove the large technology companies from the S&P 500, the rest of the index is actually outperforming the Nasdaq by around 4 to 5%. This suggests that investors are beginning to question the return on investment from the massive AI spending over the past few years. As a result, capital is gradually rotating away from pure AI and technology and moving towards traditional sectors like energy, metals, mining, and industrials. These are exactly the sectors where India has strong representation and structural advantages. When we look at foreign investor flows into India, we can clearly see a pattern. Over the last couple of years, foreign institutional investors were largely selling Indian equities. However, when we look at the sector-wise flows, the picture becomes clearer. India IT, which faces the biggest uncertainty due to AI, has seen heavy selling. But sectors like industrials, financials, energies, metals, and mining have actually seen strong buying from foreign investors. This tells you something important. Global investors are not moving away from India. Instead, they are rotating capital into sectors where India has structural strengths. After allocating massive capital into AI globally, investors are now searching for opportunities outside that theme, and India is well positioned to benefit. So, if we step back and look at the broader picture, three important things are happening. First, geopolitical shocks historically create temporary market corrections, but they are often followed by strong recoveries. Second, 18 months of market consolidation has significantly improved valuations in India, bringing them closer to long-term averages. Third, global capital is slowly rotating away from pure AI theme towards traditional sectors where India has a strong representation. In situations like this, the biggest risk is not volatility, it is reacting emotionally and exiting at the wrong time. For long-term investors, phases like this have historically been periods where future returns are actually bid. And sometimes in markets, just like in life, it is the darkest moment that comes right before the dawn. We at Magnus are very bullish on the long-term prospects of India, and our investors continue to hold some of the most solid businesses out there. If you like this video, please share it with somebody who might benefit from it. And it would be great if you can subscribe to the channel as well.